Okay, everybody. I am traveling this weekend. I'm out in San Diego at my college roommate's retirement from the Navy. So Conan and I are not in the podcast studio, and so I'm going to record this one on my own. It's probably just as good. Honestly, this is a very chart-heavy week. So what we're going to do is take a look at the 11 sectors that make up the S&P 500 and kind of talk through them and where they are in terms of sector rotation and all that. We will be back in the podcast studio next weekend, and we'll give you guys an update about our travels and all that at that point. All right. So here's what we're going to do. S&P 500 is made up of 11 sectors. Okay. So what I did here is give you guys the ticker symbol for each of the sectors within the S&P 500. Okay. So there's 12 ticker symbols here because SPY is the overall index, and the other 11 make up the S&P 500 index. Okay, so we're going to go through all 12 of those charts relatively quickly, but there's a few things I want to point out. The bonus chart is going to be a couple charts from a recent video that Larry Williams put out, and I'll give you the link to that video on YouTube when we get to it, and then the TSP Fund Charts. Okay. So S&P 500 has 11 sectors. We'll just start with the index overall. Okay, so all these charts are going to be weekly, and they're all going to go back, a little bit before 2022. So all the charts are going to look the same. You got the 20-week moving average line in blue. Each tick here is 1 week of price movement. Okay, and this is as of the close on Thursday. Okay, so I'm recording this on Thursday after the close, and so we have one more day of trading this week. But as of Thursday's close, here we are at 429.13 on the SPY. If you were looking at SPX, it would be 4,291. Okay. All right. So the index in general. Okay. Here we are at the bottom, or at the beginning in 2023. Okay. So the S&P 500 overall has obviously been going up since the beginning of 2023. Okay. We had this correction here, big week, down week, but for the most part, we've gone up all year 2023. Okay. The overall index. RSI is 63.9, so it's well above 50. MACD, crossed positive all the way back here in November of 22. Had a little bit of a head fake here in March, but for the most part, we got a buy trigger back here this week right here, and we've been in that buy trigger on a weekly basis ever since. So that's the overall index for the S&P 500. And so now the 11 sectors that make that up. So the first one is tech. Okay. So tech also bottomed here in December 22 and has been the main driver of the overall index higher. Okay. So for the past couple of weeks, we got a little bit of a pullback, right? You wouldn't call that a correction. It's just a kind of a pause in the most likely continued uptrend. But we got a little bit of a pause. Okay. So that's kind of what we're talking about sector rotation, right? All this in here since pretty much the whole year. Tech, communication services, and consumer discretionary are the only three sectors of the 11 that are actually higher for the year. Okay. And they're the three that drove the index to be higher for the year. So tech, a big contributor to the overall index going higher. And right now it's just taking a little break. Okay. Pretty overbought. You know, can tech continue to go higher? Yes, but it's definitely at a point where we should expect some kind of pullback. We could get a pullback, down to this 20-week moving average line. On a percentage basis, it would be a pretty big pullback. But as we'll get to it in Larry Williams' video, I wouldn't expect the market to break to the downside there. I would expect it to come down, get support, and keep moving higher. Okay. So that's tech. XLK, if you want to follow that. it's the ETF. You can probably find a mutual fund that tracks the XLK, but if you're in a brokerage account and you're trading ETFs, XLK is it. Okay, the next one is consumer discretionaries. So again, here we are at the bottom. Consumer discretionaries has also been going higher for the year. Okay. Not as explosively higher as tech has, but certainly has been trending up throughout the year. We got a lot of support at that 20-week moving average line and a pretty explosive move in the last 2 weeks. RSI obviously looks really good. MACD looks really good. So I would expect consumer discretionaries to keep on moving higher. Communication services, also a bottom in December 22, moves higher throughout 23. Again, not as strong as tech, but pretty strong. We got a reversal week this week, so we'll see what happens there. But we're not too overbought in RSI, and MACD still looks really strong. So communication services looking very good. All right, so those were the three that were positive for the year. Okay. So now we flip to all the rest of them. So the first one is energy. Energy is kind of important because in 22, right, basically everything was down, but energy kept going up all the way to the end of 2022. So the energy sector, while the rest of the market was going down, energy was really the only sector that was going up in 2022. But since then, right, these charts are almost going to be the reverse of the last three that we looked at. Here's the beginning of 23, and we're in a decline, right? So energy has been dragging on the overall index this year. And right now, where are we at? We are bumping up against that 20-week moving average line as resistance this week. MACD crossed, RSI rather, crossed the moving average of the RSI, but it has not gotten above 50 yet. And MACD still has not crossed positive. So we don't have a buy trigger yet for energy. However, we do have a double bottom here, and this is going to be, we're going to see a lot of this for the remainder of these slides. We get a bit of a double bottom, and for the last 2 weeks, energy is up, right? So while tech for the past 2 weeks has been down, energy has been up. So some money is coming out of tech and going into energy, okay? Sector rotation. So the next one is industrials. Same kind of idea. Here we are at the top in the beginning of 2023. Industrials has been trending down so far this year, but the last 2 weeks, huge moves higher. We are just about to have a buy trigger in industrials. It's close enough. I mean, it's going to cross. MACD is going to cross positive here, probably by the end of the week. We're obviously above the 20-week moving average line. 2 huge weeks for industrials. So capital is obviously reallocating from tech, consumer discretionaries, and communication services into industrials. Next one's financials, right? A whole bunch of support down here. Last 2 weeks, pretty strong. Again, hitting resistance at that 20-week moving average line. RSI not quite above 50. MACD not quite turning positive yet, but they're both, they're going in the right direction. Money is reallocating out of tech again into financials. Consumer staples. Okay, so consumer staples are toilet paper and Cheerios and things that you need during recession. So you would expect consumer staples to go higher as tech and consumer discretionary and those kinds of sectors trail off. You would expect consumer staples to move higher. The fact that consumer staples is really not moving higher at this point basically indicates that it's still a risk-on environment, meaning investors are buying into tech, consumer discretionary, and those kinds of sectors rather than being too worried about an upcoming recession. So we certainly don't have a buy trigger For consumer staples, it's a down week so far, below the 20-week moving average line. RSI below 50 and declining, and MACD crossed to the downside 2 weeks ago. So there's not too much concern out there of an imminent recession based on the price action of consumer staples. Real estate. So real estate should be declining, and of course it has been since the top in 22. Clear decline, and here we are at the beginning of 23. It's gone relatively flat, but trending down. Definitely has been a drag on the overall index. But again, the last 2 weeks, sector rotation into real estate, RSI is just below 50 and MACD has just crossed positive. So if price can get above that 20-week moving average line, we would have a buy trigger for the real estate sector. Materials, building materials, right? Same kind of thing, double bottom here. Here we are in 23. So basically flat. Building materials hasn't been too much of a drag on the overall index, but we got a double bottom here and 2 good weeks. RSI above 50, MACD about to cross positive. So we're just about to get a buy signal on the materials sector. And so obviously the point here is that sector rotation is definitely happening during the past 2 weeks. And while tech, consumer discretionary, and communication services has driven the overall index higher, as the other 8 in the overall index improve, tech, communication services, and discretionaries can pull back because because the other sectors can pick up the slack basically, and then the S&P 500 as an index overall can continue to move higher. So that's the value of excuse me, the value of understanding sector rotation and what it looks like. Utilities. Utilities tends to be one that also does well in recessionary areas, but same kind of thing. Got a double bottom. Last 2 weeks are good. We're still below that 20-week moving average line. RSI is trending in the right direction, but hasn't gotten above the 50 line yet. And MACD still has some work to do. So kind of like consumer staples, if recession fears come back in a big way, you should see utilities start to move higher. But since the beginning of 23, they have been trending down. And the last 2 weeks, we get sector rotation into utilities. Healthcare, pretty much at a top almost just before, so a top kind of in November, December 22, been trending down. Last week was a really big week for healthcare. This week, it's pretty much consolidating some of the gains from last week. Hit resistance at that 20-week moving average line. RSI got up just barely to 50, but is kind of rolling over a bit this week, and MACD doesn't look great. So no buy trigger on healthcare, but we can see that there's some sector rotation going into healthcare. Okay. So hopefully that gives you guys an idea of what's happening under the hood of the S&P 500, our C fund. Don't get too worried if tech starts to pull back here, even though it's the sector that's been driving the market higher all year. The other sectors within the S&P 500, as sector rotation continues, the remainder of the sectors can continue to push the C fund higher. Okay. So the bonus chart, Larry Williams, you guys definitely want to take a look at this. It's his most recent forecast on YouTube. A lot of really good information in there. I'm going to go over 3 charts that he does. This is like a 45-minute presentation. Definitely well worth the time to take a look at it. So the first one is his long-term market cycle chart. So long-term. So we're back here at the bottom of 2009. The cycles, they don't match up exactly. It's not a perfect timing tool. It's pretty close. We can see it's coming down to a bottom that bottomed a little bit before the actual bottom in price, and then cycle comes back up. We're having a rally, cycle comes down. We got some churning in here. The basically what you want to take away from this long-term chart is that when you're at a top, you should be looking. The bias should be looking for a significant rollover. Okay, if you're at a bottom in the cycle, you should be looking for a bottom and a reason to get back into stocks. So it helps to give some kind of reference in addition to the moving average lines and technical indicators and all that. If you know the cycles and where they generally fall at the peaks and troughs, you can get a pretty good idea that if we see a bottom like we did last October, that would be a bottom that you would want to buy. For example, right here, this bottom was a little bit after the actual bottom in October, but you get the idea. The cycles are pretty valuable to understand in the long term. So that's the long term market cycle. This is kind of a close up of the long term. So it's the same chart. It's just we just have a close up. So like I said, here's the October low, and the final bottom of the cycle happened a little bit after that October low, but you can see we have a decline. Stocks start to pick up. And so what we're looking at for the remainder of the year is we have this cycle, this big move continues higher. Okay. So in the big scheme of things, this is a weekly, each one of these ticks is a week. So in the big scheme of things, we can have some churning through the summer, but the cycle is calling for the overall trend to continue to the upside. Okay. And so the reason I'm pointing out that we could have some churning during the summer is because of the short-term cycle. So if you look at the video, he put it out because he's expecting some pullback in the market from the middle of June basically until the middle of July. So if the next month he's expecting the market to pull back, doesn't mean it's going to pull back and crash. Just means it in the short term, the short cycle is to the downside until about the 15th of June. Okay. So what Larry Williams always talks about in these cycles is that it's not about magnitude, it's about direction. So for example, we had a down cycle here, and the market went sideways. It was consolidating in here, right? It didn't roll over. Price didn't go much lower, but it consolidated, right? And then picked back up as the cycle moved back up. Okay, so it's not about the magnitude of the move. It's about the direction of the move. So what he's calling for is, here we are here at the beginning of June. So he's saying the market can come down. It doesn't mean it's going to come down this far. It can just go sideways, right? It can go sideways in here until the middle of July and then pick back up. Okay, so I wouldn't get too concerned about any pullback that we have in the next few weeks, basically because we know that the longer term trend is to the upside. If we get a major pullback, that might be a little bit different story. So again, this is one tool. You would have to take that into context with the moving average line and RSI and MACD. Okay, so that's it for Larry Williams. It's a great video, well worth your time to take a look at that. I would highly recommend checking out that YouTube video. All right, TSP Fund Charts. So we talked all about the C Fund and all the 11 components of it. One last thing I wanted to point out. We are at right on the 61.8 retracement level from the top in January. So the top in January 22 to the October bottom. If you were in the C Fund and you stayed in the C Fund until the October low, and you still are in the C Fund, you've recovered 68% of your losses. Okay, that's what that means. 68% retracement. It's also the most common reversal Fibonacci level. Doesn't mean it's going to roll over here, but it means to watch pretty carefully because it's the most common place for price to roll over is that 61.8 retracement level. So let's say it rolled over, consolidated a little bit, caught up to that 21 week moving average line and then popped higher. It's in that, say that took until the middle of July. So it could be 4 weeks in there of, consolidation to the downside, hit that moving average line, and then keep going higher. Okay. So that's kind of how you would look at it in context of the video that we just talked about. Okay. S fund. We've been talking about this left shoulder, head, right shoulder, neckline. Clearly, at least at this point, I'm going to say clearly, the head and shoulders topping pattern, which is what this is, it's a head and shoulders topping pattern, it failed, right? Because it didn't break down. So the neckline is here. We didn't get a breakdown through the neckline. We got support at the neckline all the way along, and then we got a big move higher last week. So if you are a subscriber to the site, you know that we had gotten back into the stock funds a little bit. I think it was this week. It was May 19th-ish. Not because of the S fund here, but because of some other factors, the C fund and other things. We got back 50% into the stock funds. And then last week we got back 100% into the stock funds based on, at least partly because of that breakout on the S fund, failed head and shoulders pattern and breakout to the S fund. So we got RSI moving higher, looks good. MACD cross positive. So if you are following along with the Grow Model portfolio, you've been doing pretty well for the last few months. iFund. We talked about how the iFund is very affected by the dollar. Dollar's been going higher. iFund looked very toppy, which is why we are not in the model portfolio. We are not in the iFund at all right now. But it does look like we're getting some support at that 20-week moving average line, although RSI is still declining. It's not below 50 yet, but it's declining, and MACD has crossed to the downside. And again, this is on a weekly basis, so iFund is not looking super strong right now, except for it does have a higher low, and it is still above that 20-week moving average line. F fund. Everybody expected the F fund to act a whole lot different this year, but it hasn't so far. We got 2 weeks below, 4 weeks really below that 20-week moving average line. RSI is kind of flattening out, but it's below 50, and MACD had crossed positive about a month ago. So no reason to be in the F fund at this point. All right. I know that was a lot of charts, a whole lot of info in there, very technical analysis driven this week. If you didn't get a chance to watch last weekend's video, we did the 5 charts that we're really looking at right now to try to figure out which way the market is going. If you haven't had a chance to look at that podcast, I would definitely go back and take a look at that. If you guys have any questions on this one, please leave them in the comments and we will definitely get to them. All right. I expect we'll be back in the podcast studio next week. So hope you guys had a great weekend, have a great week, and we will catch up with you next week.